The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos and Dan Murphy in Abu Dhabi. These are your headlines.
First today, U.S. President Donald Trump announces he will indefinitely extend the ceasefire with Iran, allowing for further peace talks. But the Strait of Hormuz remains shut, leaving global stock markets in wait-and-see mode.
Picked to lead the Federal Reserve, Kevin Warsh tells senators he has made no promises to the president on future rate cuts.
Are you going to be the president's human sock puppet?
Senator, absolutely not.
Are you going to be anybody's human sock puppet?
No, I'm honored the president nominated me for the position, and I'll be an independent actor if confirmed as chairman of the Federal Reserve.
The UK posts its first inflation print affected by the war in Iran. Consumer prices come in 3.3% higher on the year in March. That's up from February's 3% figure. Hello, welcome to the programme. The US President Donald Trump says he has extended a ceasefire with Iran indefinitely, citing Tehran's seriously fractured government. The move comes hours before the truce was due to expire and shortly after the president said an extension was not on the table. We are yet to hear from either Iran or Israel. The president also said, though, that Washington's blockade of Iranian ports will remain in place. The UK is due to host a conference of military planners from more than 30 nations starting today, aimed at advancing a multinational mission to reopen the Strait of Hormuz.
Speaking to our US colleagues before extending the ceasefire, Trump said Iran has no choice but to reach an agreement.
What I think is that we're going to end up with a great deal. I think they have no choice. We've taken out their Navy. We've taken out their Air Force. We've taken out their leaders, frankly, which does complicate things in one way, but these leaders are much more rational. It is regime change, no matter what you want to call it, which is not something I said I was going to do, but I've done it, indirectly maybe, but I've done it.
The extension represents a sharp shift in stance taken by the president when speaking to our US colleagues just hours earlier.
I expect to be bombing because I think that's a better attitude to go in with, but we're ready to go. I mean, the military is raring to go.
Let's get out to Dan for more. Dan, the market has been digesting every twist and turn of this story in recent days, and we've seen record highs on the stock market, yet a war premium still maintained in the oil price, even if it is at a lower level than some of the highs. So just walk us through how the markets need to think about still what is a very tenuous position.
Indeed, Karen. Well, what we've seen so far, the immediate reaction in the markets has been somewhat of a sigh of relief here. Oil prices have been pulling just a little lower straight away off the back of the ceasefire extension. Equities across Asia have been trading mixed, and European futures have been moving lower in the lead up to the open here. But of course, President Trump has extended the ceasefire with Iran indefinitely, he says, and this came just before it was set to expire. Of course, yesterday we were talking about how Vice President Vance was expected to fly to Islamabad this week, but never actually officially announced the trip. And of course, Iran never officially committed to attending either. And then, of course, President Trump made this call shortly after his interview on CNBC. In a Truth Social post, he said he is extending the ceasefire at Pakistan's request until Iran submits a new unified proposal, he says, and discussions are concluded. The president said that strikes are on hold, at least for now, but the naval blockade in the Strait of Hormuz will stay in place. Take a listen.
We're not dealing with the nicest group of people, but we're dealing with them very successfully, and the blockade has been a tremendous success. They said 2 days ago, we will open the strait. I said, no, we're not going to open the strait until we have a final deal. No, we want to open the strait. They said, we're not opening. We totally control the strait, just so you understand, for all the fake news out there.
This is the second time in as many weeks that the president has backed off a threat to escalate. The very definition of the taco trade, essentially buying more time here as this confusing conflict now approaches the 2-month mark. Important to point out that Iran is yet to comment on the extension. The semi-official Tasnim news agency says Tehran never requested one. And Iran has also kept up its threats to not reopen the strait as long as that US blockade continues. So the diplomatic off-ramp looks increasingly off-piste here. And I think it's fair to say this indefinite ceasefire, while perhaps looks good on paper, in reality is probably the worst case scenario for the Gulf states. None of their core demands, including Iran's nuclear program, missiles, drones, or proxies, have been addressed. And this war now runs the risk of turning into a long conflict with no real end in sight. And Karen, to go back to your earlier point about what markets are ultimately trying to price here, you get the sense that given the conflicting news flow, given the barrage of Truth Social posts that we've seen in the last 24 hours, and given the fact that the Iranians are also now playing well into Trump's hands, that this conflict is looking increasingly complex and the diplomatic off-ramp, as I mentioned, looking further and further away. While the president has said that it is unlikely that he would go back to strikes, at least for now, while the ceasefire is in place, he also told CNBC that bombing could perhaps be an option. So again, the news flow very confusing here. It's hard to know which way to look, frankly, and as a result, we're seeing markets attempt to price that reality.
And a couple of points. The diplomatic off-ramp, it feels as though the Pakistanis trying to keep that alive so the conversations continue. The uranium enrichment that the Americans are seeking to stop, that seems a major point of negotiation. But circling back to the Strait of Hormuz, it feels as though there's a wrestle for power of that choke point. The Iranians were so keen to ensure that there was some sort of charging mechanism, that toll booth that would be operational from here. But it feels as though the Americans are very keen to smash that. That still seems like a priority, doesn't it?
That's exactly right. And Karen, it's important to point out as well that the president also told CNBC that the US is effectively in control of the Strait of Hormuz. Now, we assumed that was the case, given the fact that we've seen tankers being turned around and, of course, that seizure of the Iranian-flagged vessel over the weekend as well. But at the same time, Iran is also keeping up its own threats inside the Strait of Hormuz. Both sides seeing this as a key piece of the jigsaw puzzle when it comes to maintaining leverage coming into any potential future talks. And it seems as if there's no signs on either side that they're willing to relinquish that control or relinquish that leverage. Again, where this leaves the Gulf states is, of course, in quite a confusing situation here, because for a long time we've heard from leaders here that this is an international waterway that needs to be opened. That also appears to be the view from the European side as well. The path to actually reopening Hormuz also looking increasingly complex right now.
Dan, thank you very much for that. We do appreciate it. In the meantime, the UK Maritime Trade Operations Agency says it has received a report of a container ship being hit by an Iranian military gunboat, causing heavy damage to the ship's bridge. The agency said the crew of the vessel is safe after the incident, which happened in the Strait of Hormuz, 15 nautical miles northeast of Oman. Now, we're going to push on to some data that has been crossing at this hour. I've been closely watching the wash-up of some of the numbers this month in reaction to the war in Iran. And the latest inflation numbers out of the UK tell us a story of the impact. We've got a 0.7% lift in March CPI on month, taking the total number to 3.3% on year. So more elevated is what we're witnessing versus the February number of 3%. So we are picking up some steam. In terms of what we're seeing on these numbers, the UK March core CPI ex energy, food, alcohol and tobacco plus 4% month on month, in line with the Reuters poll. So we are certainly seeing a pickup in receipts here in terms of service stations numbers, thanks to petrol prices being higher. They've got the March producer output prices lifting 2.6% year over year. That is versus 1.8% in February. So you can see clearly at the producer prices level that this is running through hotter than anticipated, also above what a Reuters forecast was expecting. The output prices on a monthly figure, 0.9% over the month versus February, where you had a decline of 0.5%. So again, at that very factory gate level, you are seeing some steam coming through. Services. This is the area where the central bank also quite focused on, away from trying to see their way through any supply shock on the oil side. Services is keenly watched, 0.5% lift on the month. This is again hotter than the 0.4 anticipated. And over the course of the year, 4.5% on services versus 4.3. And this type of number is typically what can stir the central bank, the Bank of England, into action, that you've got some embedded inflation coming through on that services side. So this is interesting, given, don't forget, the Bank of England recently had been on hold. You'd seen them move to the sidelines trying to anticipate what could be incoming data that would be a little bit fluid given the situation in the Middle East, and now we've got this data coming through hot. So the question remains around what we could see in reaction. Sterling has, as you can see, put on a slight build, 135.15, but we do have the US dollar in retreat, is what we've been watching the last 24 hours or so. So dollar sterling this morning, you're seeing a little bit elevated. Yeah,
and this CPI print takes it into line with the US latest inflation print, but both obviously higher than what we're seeing in the Eurozone. So the challenge facing the central banks, I suppose, in this situation is a realization, perhaps, and you'll be more aware of this than I am, having spoken to so many of the central bankers, that given that a lot of this inflation is being driven by the energy price shock and the high oil price that we're seeing, that actually, even if they were to raise rates, that's not going to bring the oil price down, and potentially just puts the brakes on the economies even more, which the oil price, if it's squeezing consumer spending, would be doing anyway. So it's a really tricky position.
It's the single mandate for a lot of these central banks away from the Fed, and that's around price stability. So if there is any sense that you start to stray away from steady or lower inflation around target because of second round effects, that is why central banks decide to act. And at this point, is it too early to ascertain the second round effects? For instance, you pay more at the pump, so you go back to your employer and say, I need a wage hike because I need to pay for all the extras that are coming through my wallet and through my household. That's that second round effect. And don't forget, we did see some movement in the labour market yesterday too. We actually saw the unemployment rate lower. So it does tell you that there is still a fairly strong labour market. Let's push on and get to Sue Nofka, who is head of UK equities at Schroders. Sue, thank you very much for joining us this morning.
Thank you.
We were just raking through some data on the UK economy. I know you're very much an expert when it comes to UK equities, but a lot of factors driving interest in the UK stock market right now, not necessarily the domestic picture. So how would you plug in the relevance of any of the inflation numbers this morning?
Well, inflation really affects more of the domestic areas of the market, and the UK market is dominated by international companies. About 3/4 of the companies in the stock market are very global, so that leaves about 1/4 of the market that's much more domestically orientated. And inflation really does drive the economy. The stock market is quite different to the economy. If we come back to the economy, it's consumers, it's confidence, it's spending, and it's also about the government. So the government fiscal position really does dominate demand for sterling and the price of sterling assets in the marketplace.
Fulsome response there. When it comes to the UK stock market on the back of the last number of weeks, there has been an element of resilience, and that is thanks to some of the big energy players that have been responding to a big spike in the oil price. That said, we've seen the flip side of the trade where there's been a slight unwind in the oil price, again impacting those energy companies. So how do you make sense of the pattern that you're seeing in those energy names?
Really trying to take a longer term view. So we've seen oil move from broadly 60 to broadly 100, a little bit more when it looks as though things are not on a path for de-escalation, and a little bit less when it looks as though we're getting to resolution. We're seeing an awful lot of balance within the market. The energy companies, there are other commodity plays which are also pretty firm. Utilities have played into that. And then, of course, there's everything that benefits when oil prices come down and energy costs moderate.
Sue, I suppose for investors looking at the attractiveness of the UK and UK equities, they'll be factoring in the political landscape as well and the uncertainty that may come after the local elections. And I just wonder how much that plays into maybe the lower valuations we're seeing compared with other markets?
Yes, we've had low valuations or lower than other equity market valuations for UK equities for an extended period of time. Since 2021, actually, the UK market has been on a bit of a re-rate. It's been mainly those larger companies, and we've seen banks, then energy, commodities, aerospace and defence, all participate in that. So there's been a rolling kind of sectoral re-rate, pharmaceuticals probably as well from the middle of last year. And the different sectoral makeup, together with low valuations, has really powered some more interest. So yes, valuations are still pretty appealing. They're very appealing further down the size spectrum, and that's because of the questions around policy and politics that is weighing.
When you look at the composition of the FTSE 100, it has a lot of firms on there that trade internationally, that derive a lot of their income from overseas. In some senses, that can insulate them if there is a downturn in consumer sentiment domestically. But in a world where there's so much uncertainty around trade, I mean, the tariff situation with the US, that hasn't gone away. We may not be talking about it as much because of the Iran war, but that potentially is a headwind for some of those big companies, isn't it?
It's a really interesting question, that international and global nature of companies. But these companies operate locally, globally, if that makes sense, rather than export. So that's the difference between the UK stock market and, say, the European stock markets, where you've got a lot of export-orientated firms operating from Europe into the world. In the UK, our global businesses are operating in the US, in Asia, mining things, supplying. So it is quite different. They've been less impacted by tariffs. And of course, the UK had, for most of the time, a better deal than many other countries.
You've been alluding to the impact of fiscal policy and the politics at play, and the reality is political chaos is not far from number 10 at any given point. Given we are watching the events very closely again around Keir Starmer, around Peter Mandelson, and whether there's any impact on his position, therefore any impact on the way politics run here in the UK. The bond markets are being concerned about any swing to the left, for instance. What is the potential risk around equities, and is any of this priced into the UK market?
All great questions. I'll take the what's priced in. Quite a lot of political risk is priced in. If we look at that more domestically orientated mid-cap, which represents about 10% of the overall UK market and is about half domestic and international, that area of the market has derated savagely from high teens to not teens, about 12%. 12 times price earnings ratio. And so I think a lot of political risk is priced into that area of the equity market. If we look at gilts, the 10-year yields have moved quite extensively. If we look at interest rate expectations, we've moved from pricing in 3 cuts broadly earlier this year to pricing in two hikes. And that's come back a little bit, but there's still quite a lot of nervousness already priced in. So I think the risks are quite well balanced between the political downsides and implications, but also these are really attractive companies. And how do we know that? Companies themselves are participating in share buybacks. There's quite a lot of interest in M&A from outside players who are prepared to look through that shorter term political smokescreen into the longer term opportunities.
Sue, when you look at sort of the longer term picture, it feels like a lot of the relief that's come in markets that's pushed them to record highs despite the massive uncertainty from the Iran war and the energy price shock is technology and AI. You know, the S&P 500 in the US has recovered its losses since the Iran war and has hit new record highs. Similarly with the NASDAQ, the Japanese market, the Korean market pushed up by chip makers, SK Hynix and tech company Samsung. With that in mind, do you think the UK equities market lacks enough of a presence of tech and AI companies to actually ride that wave when the enthusiasm really comes through?
I would look at it in a slightly different manner, in that the UK is stocked with lots of companies that are going to be beneficiaries of AI. So taking the technology and finding cost savings. We've got lots of data companies, we've got lots of professional services and employee-rich companies who really want to use this technology to get more efficient, to get on the front foot. And I think that is something that people underestimate, whether that's in the banking sphere, whether it's in retail. We're talking to companies day to day, and they can see multiple opportunities to improve their businesses.
I suppose the key to it is the onus is on them to make sure they use it to benefit them rather than becoming obsolete or replaced as a result of it.
Yeah.
Sue, thank you very much. Sorry, I thought we were carrying on. We're out of time. Sue Nofke, head of UK equities at Schroders, thank you very much indeed for your thoughts and analysis there. Right, you may be wondering where Steve is. Well, you've probably seen. He's in Singapore and he has just wrapped up a panel at CNBC's Converge Live with Singapore's Minister in charge of Energy, Science and Technology. And they've been discussing how the country looks to build resilience in its economy amid an ever-changing world.
When we prepare our own resilience, our own sustainability and our own independence, we plan multiple scenarios, and we've been planning from the day we became a nation, from the day we became independent in 1965. So you could say that all of our lives, all of the period of our nationhood, we've been planning. And our contingency planning goes beyond just geographical chokage, geographical outages. We even take into consideration timelines. So there are multiple dimensions in terms of how we plan for it. In this particular crisis, the key to how we will eventually be able to sail through would be really how we have diversified the different sources of energy that we have today. And even within each source generation, each energy source generation, we intra-source diversify where we get the supplies from.
Still to come on the show, President Trump's Fed chair pick says he has not promised rate cuts. Plus, more from the president's interview with CNBC, including his message to companies on tariff refunds. And we'll get a check on the tech sector with the EMEA Managing Director for Amazon Web Services. That is coming up at 7:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
A Federal Reserve Chair nominee, Kevin Warsh, said he had made no rate cut promises to President Donald Trump, assuring senators during his confirmation hearing that he would act independently. Warsh faced pointed questioning from both sides of the aisle.
Are you going to be the president's human sock puppet?
Senator, absolutely not.
Are you going to be anybody's human sock puppet?
No, I'm honored the president nominated me for the position, and I'll be an independent actor if confirmed as chairman of the Federal Reserve.
Well, speaking to our US colleagues, President Trump praised his pick for the Fed chair role.
I think Kevin's great. He's central casting in a true sense. Okay, I think he's going to do a great job. Yeah, if there's time for, I've been in favor of interest rate rises to stop inflation. I think it sort of is effective. But there's one thing, and nobody ever talks about it but me, unfortunately, so I'm sure it's not correct, but I think it is. We should have the lowest interest rate in the world.
Well, getting some insights there into how that relationship between the president and the likely next chair of the Federal Reserve will play out. And I think what's really interesting, the words that have emerged this week, that, as you heard a moment ago, he will not be a sock puppet. But interestingly, Karen, was the statement earlier from Kevin Warsh the day before saying that he believes the key to Fed independence is for the Fed to stay in its lane. And quite what he means by that, I think a lot of investors will be trying to read between the lines and get the sort of sense of his approach, while also remembering that I suppose there is a danger of overstating the power of the chair of the Fed. Yes, it's an influential position, but ultimately he will not set rates unilaterally. It will be the committee, as everyone knows, and it comes down to a vote. And so there is limited scope for him to, if he were feeling pressure, for example, to act as a result of that. So I think those safeguards that are built in should, in theory, work and should give the wider markets and investors confidence.
Already there feels as though there could be some tension among members that the removal of some of the forward guidance that's been out in the marketplace is something Warsh has been angling for. A very strong commentary from a lot of the members about all the data points they're raking through in their own districts, and then they volunteer that in terms of their opinions as to where interest rates should be going in future. Some of this Warsh seeking to try and mute that he doesn't want that communication necessarily out there in the public arena. So that's interesting in terms of the sort of sea change you could see for the US economy, the ability for rates markets to predict where rates go. And if you think about a by and large comparison to Europe, they've largely done away with forward guidance in recent times because they're data dependent. They had so many different events that are steering them in different directions on policy that they're not providing that forward guidance. So removal of some of that eyesight would be very interesting for US markets. The other point here is that it's a run it hot type of approach to interest rate policy in some ways, that Warsh believes there will be AI-driven efficiency gains, productivity gains, and maybe even some deflationary elements coming through because of the technology. Whether that is the case remains to be seen at this stage. And what impact will it have on productivity? What impact will it have on price stability? I think we can all debate that. There could be actually hits to resilience because of AI. We've seen tailwinds on the other side. It's been very resilient, pushing through the stronger growth story in the US. So if we see a sort of an element of interest rate reductions coming through at a time when you've got much stronger economic growth, do we stray away from that price stability element?
Yeah, and I suppose the other elements around it, getting through the Senate hearing is one thing, but if matters are held up by the investigation into Jay Powell, that's, that is another factor that plays into it. Trump has indicated he will not drop that investigation, but some lawmakers from within his own party have made it clear they will not approve the nomination until that investigation is dropped. So we shall wait and see how that plays out.